Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics on a Thursday afternoon, and quite excited. We have a special broadcast today because joining me live to talk about the recent gold rally and rally we've seen on the silver side as well. So, certainly some nice conditions heading into the end of the year, which we will dig into. Fortunately, I am joined today by Steve St. Angelo of the SRS Rocco Report, who's also going to update us on some of the energy dynamics that are going on out there, which is a big part of an energy intensive mining industry and often gets overlooked, but it'll be great to get Steve's insight into that and also hear Jorge's perspective on that, obviously, as Jorge Ganoza of Fortuna Silver is on the ground and getting us a lot of these metals that the world needs at a time where the need for a lot of metals is going up quite a bit. So, with that said, Steve, great to have you here today. How are you doing?
Doing great, Chris and Jorge. It's great to be here. I've been following the precious metals since I purchased my first ounce of silver 21 years ago, and so I've been doing this for quite a long time. And I think the future of the precious metals and the miners is going to the bright star, or the good times are really ahead of us. And I do think the market doesn't quite understand how good the future is for the metals and the miners.
Well, it's great to have you here and looking forward to digging into some of those things. Been a little while, probably about a year since we've done this, Steve. So,
Yeah.
to have you back. And Jorge, always a pleasure to have you here with us today. And nice to see you're back in the home office. I know you've been traveling around the world telling people about the developments that have been going on with Fortuna. And it's really nice the way that the timing of things have come together as now Seguela is up and running and producing gold. You guys had a great third quarter, and now we have a higher gold and silver price as well to join in with all that. So welcome back on in, Jorge. And how are you doing, my friend?
Chris, thank you for the opportunity to be here again, and Steve, join you with Steve. You know, we try to put together a company that can thrive, as I always say, throughout the precious metals price cycle. But certainly, we undoubtedly enjoy times like this when we start to see strength in the metal. What we saw the trading on Monday in gold as a sign of things to come. No, yeah.
Yeah, and perhaps that's a great place to start. Obviously, on Friday of last week, we hit a new record all-time high in gold. Had quite an interesting, eventful opening on Sunday night in the Far East, where gold price shot even above 2150. Did not stay there very long. Although, Steve, perhaps we could start with you. Your thoughts on the recent rally, which I'll pull up the chart. Uh, Amazing to imagine. Just about 2 months ago, we were down there in the 1830s, of course,
Yes.
before unfortunate conflict, never a good thing to see in the world, but certainly contributed to the rally, although I don't think that's the entire picture driving the metals at this point. So, Steve, perhaps you could share what you've been looking into and any thoughts on the price increases we've seen in both gold and silver in the last 2 months.
Well, it seems as if we haven't seen a lot of metal flow into the ETFs, and that's been either the gold or silver ETFs. That tends to have been more of the driver of the price, especially during the pandemic shutdown, as well as the Russian-Ukraine war. But what's changed is we've got a lot of central bank buying of especially gold last year, and they continue to do that this year. So I think they've been putting a pretty good bid. And also, gold and silver have been trading the inverse dollar trade. And so we've been seeing that over the last month and a half. And so that's what's kind of pushing the gold price up. And then we broke above 2000, and traders look at this. When it breaks above 2000 on a monthly basis and it closes above it, that tends to put a spotlight on traders and investors. And so then what you get a lot more people moving in because this is a breakout number. And then we saw in early Asian trading how it went to 2130 in a very short period of time. Now that was short lived, but the interesting thing I've seen when you see these massive spikes and then it comes back down, the price actually ends up going back up to that number. It takes some time, but typically when you get that spike, it isn't up there for any reason. It's up there, and then the price will retest that. And so I think we're going to revisit that 2130 in the future. But again, with the gold price breaking above 2000 and closing above it at the end of November, this has been a good sign for a lot of traders and investors, even though it's been very volatile. I mean, look at we're above 2000, and it's a very interesting time to see gold now above 2000.
Yeah, I know what you mean, especially because you have the technical traders out there and they do have certain signals they look for. So seeing that monthly close certainly checks off one of those buckets. Of course, another thing that has factored in is that we've had the market perceive Jerome Powell's latest comments as a bit dovish. And I keep wondering if this is the type of reaction we see when he still comes out and says, well, we might have more rate hikes. Makes you wonder what happens when we finally do get an official pause and now rate cuts, which are being forecast even as early as possibly March. Steve, any thoughts on the timing of when we might see rate cuts or anything out of the Fed and how that will impact the metals as well?
Well, it wasn't Powell that came out with that comment. I think it was one of the Fed governors, and so it will be interesting to see if Powell does come through and start lowering rates in March or April. But even if they do, I don't think they're going to just drop it as fast as they increased it. They may lower it a little bit. And you see, this is what I mentioned in my last interview. What's interesting, since Powell has raised interest rates, started February last year, March in 2022, raised it about 5.2%. Janet Yellen, the Secretary of Treasury, has added 3.5 trillion in new debt. So you've got the Treasury and the Federal Reserve fighting each other, because the Federal Reserve is trying to get inflation under control, and you raise rates, and that's what happens. That's what they try to do. And on the other side, you've got Janet Yellen stimulating the U.S. economy by adding 3.5 trillion of new debt treasuries. And so they're kind of fighting each other. And that's the reason why we're not really seeing the markets kind of roll over. And so if they continue to add more debt, and I think they are, I don't know if we'll continue to see lower inflation. We could see even higher inflation. But one thing I'd like to ask Jorge is, one of the factors that impacts the production of gold and silver is the cost of energy. And so it's probably a good sign now that we're seeing oil roll over. It's below 70. So how long does a lower energy price start to impact lower costs for Fortuna? That would be interesting to know. Is it a lag time, or does it like in a quarter? It'd be interesting to know with these lower gold prices, lower energy prices, definitely helps the gold mining industry.
Yes, and the issue is that sometimes the price does not behave necessarily the same from jurisdiction to jurisdiction because of different factors. But yeah, it transfers rather quickly. No, any change transfers quickly. No, and there is no big lag. I would say that within a quarter, within a couple of months, you're already seeing the impact of any swing. But I would like to add some perspective to something that Steve was sharing with us with respect to where is the interest in the metal being coming from. I fully subscribe to what Steve said. It's central banks buying. And I would like to share some insight. In 2008, 2009, 10, 11, I could have endless days of meetings in some of the financial centers of the world, call it New York, London, Zurich, or whatever, Boston, with generalists, no? With generalist fund managers, guys who are not usually in the sector, but then they want to have 5% exposure in their portfolio. And we're talking about guys who manage not hundreds of millions, but billions of millions, right? For the past years, we have not seen any of that. It's just been, the dedicated gold funds with reduced pools of money participating in the sector, through some exposure in the metal, some exposure in gold, silver, and mining equities. So we've seen a shrinking pool of money coming into the precious metal sector. Now, we've seen gold reach $2,000 and hover around $1,900 to $2,000 for a while. That's been supported, I believe, mainly by central bank buying. But those large pools of managed money that sit around the world have not been paying attention. I have been holding meetings with investors over the past 15 days. We were on a marketing trip, engaging with on a communication trip, engaging with our investors, and it's for the first time that I start to see generalist funds interested in taking meetings, right? So to the point we discussed previously, I believe they're starting to pay attention, no? And we're starting to see slowly renewed interest and with that capital flows. So yeah, no, I think we're at a very interesting junction. Absolutely.
And Jorge, it's interesting you mentioned that. I've been curious about what sort of reaction you've seen as you've been to a couple of conferences internationally recently. And so you're seeing that there's more interest in the metals and also the mining stock side at this particular time, especially I know previously in the last couple of months, you've talked about how you've mentioned this might be the lowest sentiment you've seen in the mining space the entire time you've been doing this. So you're seeing that shift on both the commodity and the mining equity side.
What's happening today sends me back to 2000, 2001, 2002. There was a complete capitulation with the mining equities, right? There was zero interest on mining equities. But, correspondingly, silver was trading at $3.50 or $2.80 per ounce. Gold was hovering around $250, $300. So the underlying commodities, precious metals were completely unlocked, and therefore mining equities were, completely also out of investors' radars. And today we see gold trading at nominal heights, at nominal record levels, and the mining equities lagging behind significantly. And the explanation there is what we just discussed: is when central banks purchase gold, they purchase perhaps a bit of silver, but certainly not mining equities. No, it's not their mandate. So the price is being supported by central bank buying largely, I believe, and we're not seeing those large managed pools of capital seeking exposure to the sector yet. I believe we're at a transition point, and we're starting to see that interest pick up. That's what makes the junction so interesting, because we're at nominal highs for the precious metal. Mining equities are lagging. If we see those capital flows start coming in, I think things can go parabolic here, right? Like we saw on Monday, all right? $100 in the silver, in the gold price to Fortuna means around additional $45-50 million of revenue, right? So and that's very, things being equal at zero cost. So just a factor of price. So again, as I say, we at Fortuna, we take a long-term view and want to run a company that can thrive throughout the precious metals price cycle. But we certainly enjoy moments like this, right?
Well, I can imagine, and certainly nice to see this again happening at the time where Seguela is in full production. And Steve, perhaps you could touch on how, given where we are now, some of the energy dynamics that you write and speak a lot about in your videos, how that is going to shift things going forward, especially in an era where we're seeing debt loads and deficits get a bit concerning, is one way of putting it mildly. But
Right.
can you walk through how the energy dynamics are going to factor into all of that?
Yeah, and I'm glad you brought that up because this is going to kind of go what off Jorge said about that we're starting to get some interest in the institutional market. And that's the institutional market. It's kind of like when E.F. Hutton talks, everyone listens. The institutions, there's a lot of money behind them, a lot of assets, a lot of flow of funds. And so the thing is, the mining industry, the precious metals dealers or the precious metal industry, as well as the mining industry, is competing with the financial industry. And so I put this statistic out last year, and this is my guesstimation, the gold mining industry, it cost them total cost about 200 billion to provide 232 billion in gold. And that's about 116 million ounces. These are rough numbers. So in 1 year, the costs were very high to produce that gold. Now the US Treasury added 2 trillion of new debt and new treasuries with zero cost. There is some cost, but the only cost they have is the servicing cost, which now it's about 60 billion a year just on that extra 2 trillion of treasury issuance. So unfortunately, right now, the mining industry and the precious metals sector is competing with that, because when you can issue 2 trillion in treasuries and it really doesn't cost you anything, that's really not a good value, because it takes a great deal of energy, money, materials, labor, and risk to produce gold and silver. And so I think the issue is going forward, and my analysis is on the energy, is we're going to kind of see a energy, let's say we're hitting a peak of overall energy. Well, we can add more energy. It's not oil supply. It's not like what we had in the last 15 years. That's very bad news to all these treasuries and finance that has been added to the system. And when I spoke at the Silver Symposium, I put out a chart starting at 2007, the global financial crisis, and I got 3 lines. One line is the oil increase in oil consumption. And guess what? There should be about a 1-to-1 increase in oil consumption in the world and GDP. But the GDP increased almost twice as much as the oil consumption in the world. Guess what? The financial assets increased 10 times the amount of the GDP. So what I'm trying to get investors to understand, we just have enough energy to produce the goods and services, the metals, the food, genes, the energy, the cars, the electricity, run our homes. We just have enough energy to do the GDP and to produce all these goods and services that we trade on a daily and yearly basis. Unfortunately, we won't have the future energy to settle all that 500 trillion now in financial assets. And so what I think institutional investors and other investors are starting to understand, when the Western central banks like the United States can add 3.5 trillion in new debt in a year and a half, that has to be absorbed. Well, we see a lot of the central bank buying is the Eastern central banks. Yes, some banks, central banks like Poland, they're more Western, they're buying gold, but it's mostly the Eastern central banks that are buying gold. And there's a reason for that. And so I think as the next several years start to play out, more institutional investors, more investors are going to start questioning, is the ability to continue adding finance and debt, is that sustainable? And it won't be, due to we don't have that growth of energy to continue adding a lot of economic growth. And so I think this is why I'm trying to educate the investing public, why they need to understand why precious metals are so important, as well as the miners, because they're going to provide the future supply of the metal. And so I think this dynamic is totally overlooked by the institutional investor, because they think that the next 15 years is going to be the same as it was in 2007. And think about this last figure. In 2007, there was 4.5 trillion in US treasuries outstanding. Now there's 26 trillion. And that was all due to funding our deficits. And so I don't think the institutional investors really understand, even though they can get a 5% interest in investing in treasuries, that's going to become more unsustainable in the following years. And they're going to have to protect their wealth into real assets. And unfortunately, if you can increase the treasury supply 21 trillion in 15 years compared to the gold supply value, which is like a 60th, this is where institutions are starting to wake up. But they don't get these dynamics, but they're starting to realize some of these things aren't making sense.
Yeah, and Steve, I know you pointed out that we're just about at that point where we're at peak energy now and getting close to beginning that phase of decline. Obviously, it's an imprecise science, but any sort of timeline of when you see some of these dynamics really, the market being forced to price these things in and address them?
Well, the number I put out is 2025. And as I mentioned, that the GDP in the world growth, and there's been several, Jean-Marc Jancovici did a presentation in front of the OECD back in 2019, a large group of leaders in OECD showing there's a direct relationship between oil consumption per capita and GDP growth. Direct relationship. When you have growth in oil consumption, you'll have growth in GDP. And so the issue is, my data shows about 2025 is when, if we don't have a huge recession, is when we hit that kind of peak. Now, we could grow some more. The problem is we've hit the Red Queen syndrome. The declines that are coming in the world we're running 100 million barrels a day of production. To offset that, we lose 10 and 11 million barrels a day every year. And so it's very difficult to maintain that, but we will be in a plateau for a while. But that, you see, the issue is that is bad news for the finance. It's not bad news for the metals. It's not bad news for the miners. It's very bad news for the finance, because that finance has gone up exponentially. While the gold supply has increased, it's increasing along with the population. The finance has gone way too much. So I think 2025 is the time frame we start to get into trouble. And I talked about this, and I'll conclude here. Europe hit the problems with natural gas because they're the largest importers of natural gas in the world. They hit already that trouble in 2021, 2022. And so I think the world doesn't really quite understand how these dynamics are going to play out. And that is why I'm passionate about letting people understand the energy problems, because without the energy, a lot of we won't have an economy. And so I think 2025 is when we start to get into where we can't really add that much more supply of oil. And that's the factor we're facing.
Okay, that makes a lot of sense. And Jorge, I'm curious to get your comments on that. Obviously, you're on the front lines handling these things, seeing it from the mining side. You're also paying for energy, and love to get your response. Any thoughts on what Steve mentions there?
You know, these things can get quite complex. And
yes, they can.
And with multiple inputs. But, you know, I think overall we subscribe to the concept that, you know, the economy is, in the US in particular, is testing its limits, right? And the issue, what gives leeway is the fact that the dollar is the currency of the world, right? And that allows that provides a lot of flexibility to the Fed, and but if this were happening to any other economy in the world, it would be a disaster, right?
Yeah.
So no, but I think you know, medium long term, we all believe that the system is compromised, and every day with the way the debt and the deficit move, the situation gets more and more complicated. From our perspective, I don't look that much at physical supply and demand of silver and gold. I look at financial demand. What moves the needle here is when people seek the precious metals as a store of value, right? And there is so much money out there that when those dollars seek to be parked on hard assets, I believe prices can go parabolic. People sometimes refer to gold as a barbaric relic or whatever. Gold has been providing a refuge for in light of financial instability, for not for hundreds, for thousands of years, right? So yeah, no, I believe Fortuna is not looking to expand into copper or other metals. We believe gold still plays a key role in the world of finance, and we supply the gold that we as society demand, and yeah, and to the point again, we go back to something very basic. Who has been buying gold over the last years? It is the central banks, right? So that's how we see our role. No, we mine with pride and purpose, and we mine the gold that we as society use to stabilize our economic systems.
Yeah, it certainly sets up an interesting set of dynamics given where we're already at, let alone going forward. And another thing that, Steve, I think you'd be one of the perfect people to ask about this. Jorge, you also were in a study recently where you commented on this as well. Obviously, we have the green energy movement, which seemingly requires almost what seems an impossible amount of certain metals. But Steve, it'd be great to hear your opinion on what your thoughts on the possibility of ever meeting these mandates are. Is that something that even could make a dent in the issue that you're seeing, and anything along those lines?
Well, the green energy, that's a conversation for another time. It's becoming problematic, and I talk about that on my website, especially with the wind power. But solar seems to be still doing well. It's not as complicated as wind. There's not as many problems with wind power as is. Solar is much better. So I still think we're going to see a ramp up in solar production and solar installations in the years ahead. So that's going to take a lot of silver. And so, as we know, more than half of the market of consumption of silver is industrial demand. And so a lot of that is gone. It's not the case with gold. And so I do think going forward, green energy is still going to be a major demand driver for silver and some gold. But I think what Jorge said in his last comment, you see, the issue is when the institutional investor and the retail investor and the 99% of regular investors who are in 401ks and pension plans and IRAs and all that, see, they're not even thinking about gold and silver right now. But when you start getting them into the understanding why they need to be owning these metals, and it all has to do with the issues with energy, then you're going to see more interest, and it's going to happen quite quickly. I think it's going to happen over the next several years. And so I think it's really not about demand from industrial demand for silver, but it won't hurt it. It'll just it'll just help it along because there's so much demand used in industrial silver consumption. So going forward, green energy will still be a major factor in the consumption of silver, but I think the real demand driver for the precious metals will be investment demand, especially for gold and silver. I actually think silver is going to surprise people. There's a lot of gold in the world, and there's just not as much silver as people think. And I think silver is very undervalued.
I'll share my 2 cents on this one. I think, just schematically, as the price cycle as a perfect wave, right? And, 75-80% of the time while you're riding the wave of prices, as a miner, no, I'm talking from the miner's perspective. If you're a silver producer, 80% of the time, 90% of the time, you wished you had more gold in your revenue, because gold outperforms silver. But then there is 10% of the time through the life of the cycle,
Right.
that silver just goes parabolic, right? It gets squeezed, it goes through the roof, and it widely outperforms gold and everything else. So from an investor's perspective, from the perspective of someone who can, attempt to time the market, it's an excellent trade. From the perspective of a producer who is mining every day, because we mine when prices are low, when prices are average, and when prices are high, we're mining every day. It's a nice thing to have, a beautiful thing to have, I might add, as a mix with the gold, right? So, Fortuna Silver mines, silver is in our heritage. But yeah, I believe that we are likely getting to a point where silver can go parabolic, right? Fortuna currently about 15-20% of our revenue comes from silver, and we're poised to benefit from that. But yeah, there is a day when silver just outperforms every other asset out there, and we might be coming close to that. And if you allow me, with respect to the critical metals for the energy transition and all of that, if we think of copper, right, there is no way in hell that we are, as a society, gonna meet our commitments, the commitments made at the Paris Accords and all of that, to bring down temperature by 1.5 degrees. There is no way we can achieve that. We're fooling ourselves. No, and people have not done the math, no, and some basic math. The amount of copper, the copper gap that will be created by 2030, which is around the corner, is about 6 million tons of copper, if we believe that we're going to have that many electric vehicles circulating around the cities. If we believe the commitments of the auto manufacturers, that means that we need 6 million tons of copper. That's the gap. And so that means that we have to open 1.5 world-class copper mines every year. A world-class copper mine produces 400,000 tons of copper annually. No, give and take. That's it. That means that we need to open 1.5 mines like that every year. It takes 16 years, from the time you make a discovery, or from the time you take a resource all the way through first production, at best 16 years, at best. No, we're currently mining deposits that have been sitting there discovered for 30 years. So there is no way we can meet those commitments. No, and it is the same people who are demanding an energy transition and clean energy who are opposing mines. It's the same people.
Yeah.
There is a crazy level of hypocrisy in what's happening here, and we don't realize it. We as a society have to come to terms with that. No, there is no way we can achieve our goals as society if we don't get rid of these nonsensical. We just saw what happened in Panama with First Quantum. 1% of world copper demand, supply is compromised now, right? It's coming offline. And it is, I don't know, I saw Leonardo DiCaprio protesting against the mine. I'm sure he drives an electric vehicle. I don't know if he's sad to reflect on who produces the copper. This is a figure that most of you guys know probably by now. A combustion vehicle demands about 25 kilos of copper. An electric vehicle, 3 times that amount.
Right.
So where do you get the copper from? No, I mean, the price incentive for new mines is not there yet. So financially, the market is telling us we don't believe all of that is going to happen, because if we believe that the incentive price for copper would be $15,000 per ton of copper, not five, right? Or 6 or 7, it would be double or triple that. It's not happening. The incentive price is not there. And then we have the structural limitations to permit, to socialize a project. These are billion-dollar, multi-billion-dollar investments, right? So I don't know. I think that we have to do, as a mining industry, a much better job communicating the relevance of what we do, and we're at a critical junction there. Yeah.
Yeah, and Jorge, I appreciate you mentioned, obviously, at a time where we need large amounts of new copper supply, we're really seemingly headed in the wrong direction as we see one of the largest copper mines shut down. So, seems to be a few impediments in some of the Green New Deal targets. With that said, Steve, I wanted to give you a chance. I know you've written about Fortuna, and if you had some questions that you'd like to discuss with Jorge, obviously, if there's anything else you'd like to touch on in terms of energy or the metals, of course, feel free to do that as well, but also wanted to save some time if there were things you'd like to get answered by Jorge regarding Fortuna.
Well, for one of the things, when I started getting into the precious metals, I couldn't really figure out how they were being priced, because they're bouncing all over the place. But then it made sense to me, which the whole market is designed this way. It's the cost of production of all the things in the world, what it takes to get them out of the ground, transport them, manufacture them, assemble them, or transport them to the store, hire the store staff. You have to pay for the store rent and all that. And so when you figure what it costs to produce things and what it costs to get them to the market, we see that, I've got a 50-year chart of gold. Gold tends to bounce off the cost of production. And so then it goes up due to a lot of either speculation or demand for various reasons. And so when you understand that, I started looking at the mining industry, especially the silver miners, to find out what it costs to produce them. Now, this is my analysis. It's different than other analysts, and it's different than the industry. But what's interesting about Fortuna, I've been following them for a while, and in the last, let's say, 5 to 7 years, since 2012, 13, maybe 10 years, the silver miners have been diversifying into gold mines, and that was a good idea to do it. However, many of them didn't do a really good job diversifying into the gold mines. So when you look at the data objectively, you see that Fortuna did a better job than its competitors in bringing on its gold mine. And so when you understand, and it all comes down to the data and the numbers, the free cash flow and the profitability. And so that's the reason why Fortuna has stuck out to me, is because they proved it when you look at the numbers. And so when you compare Fortuna to the other primary silver miners who have added gold mines, they've just done a better job. And it's not me saying that. I mean, if you can add figures up, you could see it. And so it was happy to see Segula, the mine, to come into production, and they're still ramping it up. it would be interesting to see or hear from Jorge what is going to be the annual production of gold for Fortuna, let's say in the next several years, because I think they've invested the money in the developmental capital, and that takes a lot of capital to do that. And so now they're going to be enjoying that free cash flow, those profits from those mines that they've built up. And so I believe it's over 300, it's about 300,000 ounces of gold a year, plus or minus. Am I correct, Jorge?
Yes, on a gold equivalent basis, no, we are
Yeah.
currently producing around 450,000 ounces of gold annually, right? And when I say gold equivalent, 80% of that is gold, 15% is silver, and we have a small byproduct, lead and zinc coming out of our Peruvian operation that accounts for that other 5%. So we do a bit of alchemy to put everything in a gold equivalent, right? So yeah, around 450,000 ounces of gold annually is the rate of production that we have today, right now. Right? So yeah, and to speak a bit about the journey of a silver producer, I always say something, and perhaps this adds perspective to the audience. A good silver asset is something you discover. It's seldomly something you can buy. So when you discover a good silver asset, you invest on it, bring it into production, and then if it's a silver mine, probably 70, 60, 80% of your revenue is attributable to silver, and the rest is the byproduct, right, from that one mine, because it's primarily a silver deposit. But then, as you seek growth, and you start looking for other quality silver assets, you eventually find tremendous limitations because what's actionable from the M&A perspective, what makes sense, there is certainly more opportunity flow in the gold space. That's why you find multi-asset silver producers really are all of them gold producers, no, with a silver credit. It's only with the very small silver miners, like a one asset company, that you have companies that are highly leveraged to silver, over 60, 70% of revenue attributable to silver. If you find multi-asset companies with bigger production, is usually, that's where you see the gold component of revenue growing significantly, right? And Pan American Silver is just another example of that. Hecla, Coeur mining, silver is a small percentage of revenue, and those are traditionally silver companies. Agnico Eagle, decades ago, was a silver company, right? So yeah, that's part of the journey, and it's a difficult business. Everything that can go wrong usually goes wrong. You have to be very disciplined with capital allocation. Try to keep your mistakes small. We took a big gamble expanding into West Africa for a company that for 16, 17 years had been anchored and successful in Latin America. We decided to break away from the pack and be a risk takers, and I believe it has paid off. But it's taken 2 years. No, there were some legitimate concerns on the part of investors. If Fortuna was going to be able to successfully integrate a West African business, if Fortuna was going to be able to not only integrate but successfully deliver a construction in a new continent. And I think after 2 years of hard work, we have proven convincingly that the integration was successful. Therefore, the delivery of the new mine has been successful, and we reported in the third quarter of the year our first quarter consolidating financial results from the West African region with all of the assets there in production. $70 million in free cash flow, 105-6 million of EBITDA. We expanded revenue by 53%. No, so I mean it was an excellent quarter. But yeah, I mean every time you are making an acquisition, you're taking a lot of risk, and particularly in this business, no, particularly in this business. Yeah.
And Steve, I know you've been following as they've made that acquisition, which is just about 2 years ago now, and curious if you have any thoughts on your impression of it from when the deal was announced to where they've come now, and anything you've noticed about the process along the way, or perhaps again would like to ask Jorge more about.
Well, I think the best information or analysis is as objective as possible, because there's a lot of promotional kind of work being done for the mining industry, and so of course you want to, if you're a junior miner, you want to get people to know about you. But the thing is, when you look at the numbers, and that's what I tend to do, I always look at the numbers, and so when you plot 5 or 6 of the primary silver miners, and even though Fortuna now has brought on more gold production and gold revenue, they're still kind of in that group. When you put them together as a performance basis, they've outperformed the group. I mean, anybody can do that. You just put it on a chart and you can see that. And so it all comes down to the profitability and bringing on good mines or making acquisitions. And so I think going forward is going to be the most interesting part, because as I mentioned about the issues with energy, and it's not that we have to see a big declining energy. We just don't grow much. And there's reasons for that. And that really negatively impacts the ability of central banks to print assets. See, that's what they're really doing. When the US Treasury adds 2 trillion of treasuries, people think that's an asset, and they buy them and they get a 5% interest rate. It's a liability to the US government. It's not an asset. When Fortuna or other companies produce gold and silver, and that gold and silver is held in your hand or at a vault, that's an asset. And the reason why it's a store of value has to come down to the massive amount of energy and materials and labor that went into making that. And that is really what is true value in the world. Unfortunately, most investors don't understand this, because the global economy is so complex. We don't understand all the supply chain and all the energy it takes to produce these things. And so they don't really consider the 2 trillion extra of treasuries in the last year, how easy that is to do, but it's not sustainable. And so I think going forward in the future, when Fortuna, other companies are bringing, they're still supplying that gold, the value, I believe, of that gold is going to go up. And the ability for investors, when they start to wake up that they need to protect wealth. So you really can't protect wealth in a printed financial asset that goes up very high. It's almost, we can call it it's a Ponzi scheme. So that's not really a protection of wealth. It's a asset it's a liability that's masquerading as an asset. And so the funny thing is, on the financial world, they call US Treasuries the highest quality collateral. And if you think about it, if you and I went to the bank and we wanted to get a loan for $500,000, and the bank says, okay, what's your collateral? I've got 500,000 in debt. They're going to look at you and they're going to bring everybody from the bank office and laugh at you. But that's the way it's being done with US Treasuries. If you own a treasury, which is a debt, you can borrow off that collateral. I say that the real collateral is the metals. That's the real collateral. It took a massive amount of energy and materials and labor capital to produce that. That's where the real value is. Investors don't understand that. And so I think going forward, as Fortuna has brought on these good quality mines, they're making good cash flow. I think the real bright spot is going to be in the future. And so this is what I'm trying to get investors to understand. And I do think in the future, when Jorge goes around, he'll see not only will institutions or investors start having more interest, they're going to start making that change in investment. And we only talk about it 2 to 5%. That's all that all institutions need to do to transition out of some of this finance, 2 to 5% into metals, physical, or in miners. And we're talking about, as Jorge, we're talking about parabolic moves because there aren't that many primary silver miners or small miners. There aren't that many mining companies. And so I think this is the most overlooked aspect by the investing. I'm not talking about the 1% who buys metal and invest in mines. I'm talking about the 99%. And so I think this is where I focus most of my research, is waking up the 99%. And unfortunately, only a few percentage are going to be able to access these values before they start to take off. That's how I see it happening in the years ahead.
Yeah, I know what you mean. I saw a slide yesterday. I believe it was 70% of financial advisors are between 0 and 1% allocation to metals. It was a very small figure. And, again, this isn't just people in the gold and silver community saying this anymore. We've talked about the central banks. We see a list of nations that are actively making ways to not use dollar financing. And of course, a year or so ago, we saw Russia invoke a temporary peg to their currency. So obviously, we don't know exactly what they'll do going forward, although it seems like they're headed in that direction. So will be interesting to see how the world responds to that. Jorge,
Chris, one more thing before you go to Jorge. The reason why investors are moving into a lot of this finance and treasuries, money market accounts, is because they're getting a yield. You can't get that yield by owning gold. Matter of fact, you pay to store gold and insure gold, which you should, because it's a very valuable asset. So right now, the reason why we're seeing a lot of interest in these financial assets is because they've been lured due to the higher interest rates. But these central banks cannot afford to pay that high interest rate. Right now, as of the November, I think the third or fourth largest expenditure for the US government is now interest expense. It's right above or below military spending. And so this is not sustainable. And so I think, as I've said before, and I'll conclude here, the mining industry and the precious metals industry is competing with central banks and financial institutions that can print assets. And that is something the market doesn't quite understand. That's not sustainable. And it all comes down to the energy. So we're just in the beginning stages of what I call a major bull market in the metals and the miners. And this is not like a blow off. People think, well, Steve, when it blows off, when are you going to sell? No, because the energy doesn't get better and better as time goes on. It becomes more problematic. And that makes the finance become more problematic. It never gets better. And so it just, even though you can have spikes and cycles ups and down in the metals, I think they get stronger and stronger as years go by. And that's a whole different scenario that the market does not understand.
I hear you. And it's going to be fascinating to see when there is wider mainstream acceptance of the metals, how money piles into some asset classes that are relatively small to what's out there. So Jorge, I had one last question for you, and then Steve, if you had any further questions for him, you can take it from there before we wrap up. But in terms of the process of ramping up at Seguela, I was talking with Carlos the other day, and he reminded me of something that was interesting in the sense that you were doing that in the middle of the supply chain issues, and that was going on through when conflict in Ukraine began. So 2 quick questions. A, if anything, you could comment on how you were able to navigate that. And then also, since we were talking about energy, you guys have been building a solar grid at Seguela as well. So perhaps you could touch on those two.
Yes. We closed the acquisition of Rocco in July of 2021, and the construction team was ready to launch into construction, right? We had a feasibility study and a construction plan by the time the acquisition closed. But we decided to take a pause and rebaseline our estimates, even though the feasibility study was concluded only 6 months ago, no, six months previous. We decided to rebaseline the project. So we took from July until September to carry a work and understand what were the real risks around the inflation and supply chain. Through that process, we advanced an $11 million budget to help secure key equipment packages, right? So even before the construction decision was made, we were already putting money to work and securing key equipment packages. So we were securing price and delivery time, right? By the time September came and we made public our construction decision, by the time we had increased the capex in the project by $24 million. So it's not like the project was not impacted by inflation, but we were able to successfully capture the inflation in our budgets and in our financial plans. We were not caught off guard or by surprise. We were able to do good estimates and plan for them, right? And again, the same with supply chain, right? By placing those early works orders on key equipment packages, we were able to largely de-risk the implications for the timeline. No, it's different when you made a construction decision and subsequent to that you start placing orders. Then when you have already placed some orders and when you have the certainty and visibility on delivery time and pricing, you made a construction decision. So it's completely two different risk scenarios, right? So that comes out of our experience through several builds, and that's what we implemented here. That's what worked successfully for us. No, so I think we put all of our collective experience here as a group to work, and yeah, so it was good planning, having the financial flexibility to put some of that money to work early to de-risk the timeline and budget of the project. Yeah, absolutely. So that's with respect to the first question. The second one had to do with some of our energy efficiency initiatives. We currently have 2 solar plants in our budgets. One is in our 2024-2025 budget, and the other one is in our 2025-2026 budget. So we are going to start generating solar power at our Lindero mine in Argentina and at our Seguela mine in the Ivory Coast. These are our mines with the longest life of reserves. Yeah, we're moving ahead with those projects. And that's also those projects are an important part of our commitment to emission reductions, right?
Okay, well done in a particularly challenging time. And again, it's nice to see that you're getting the benefits of all of that now, especially as the plant is up and running. And I know you had a realized gold price of $1,925 in the third quarter. Will be exciting, especially if we stay over 2,000 for the rest of the month of December. Should be fun to see how the numbers come out for the fourth quarter. So congratulations on everything that's been going on there. And Steve, did you have any final thoughts or questions that you wanted to run by Jorge, or just anything else you'd like to share before we wrap up today?
No, I do appreciate being a part of this because, as I said in the beginning, it takes a great deal of effort, energy, materials, labor. I mean, the people that work in these mines, it takes a lot of effort and work, concentration, and the risk and capital to produce the metals. And it's so simple because when you're a precious metal investor, you just call up your dealer and in 3 4 days, you've got the silver or gold, in your front door. But what it took to get it there, no one really, I call it the Amazon Star Trek or Star Trek economy. You push a button on Amazon and 2 days later, poof, it's on your front door. And unfortunately, a lot of people just don't realize what it takes to do that. And so I think going forward, we're moving to a world that building wealth is going to become difficult. So we're going to transition to protecting it. And that is a guarantee. And it's the timing of that. I think that's maybe a few years away where we start hitting that. And it's very difficult to protect wealth in assets like financial assets that can be printed, especially treasuries or bonds or bunds or gilts, whatever the different name or the different flavor of bond is out there. And so the world is going to get back to realize what's really value is the tremendous inputs it takes to produce gold and silver and things like anything else. And so I think the world is going to re-educate themselves to what is really value. And so we'll see this transition of protecting wealth. And as the institutions and investors start transitioning into that, there's not that many mining companies to go around. There's not that many well-run mining companies to go around. And there's not a lot of precious metals. And so compared to the 500 trillion in financial assets. So I think this is a good time, even though it's been very troubling and challenging for the mining industry, even the ones that are having difficulty remaining profitable. I think there's very good, the years are going to be very profitable for a lot of these mines. And the ones that are doing a great job are going to see that they're going to be rewarded by investors seeking them out over the others, because that's where the future metal is coming from. And I think precious metal investors need to understand they should be supportive of the mining industry because that's where they're going to get their future supply of metal. So I just wanted to say that and thank Jorge for the hard work that he and the folks at Fortuna do to produce the metals that we all consume and we all rely upon in the future.
And just to complement that thought about the energy that has to go into the production of these precious metals, sometimes people don't reflect on the fact that if we mine, our Lindero mine has an average gold grade of about 0.6, 0.7 grams of gold per ton. At the new mine, Seguela, we're currently mining around 3 grams per ton. What does that mean? That means that within a million grams, because that's what a ton is, 1 million grams, we have to identify, move, and extract 3 grams, or in the case of Lindero, for example, 0.6, 0.7 grams, out of a million grams. No, that's what makes gold precious. Out of 1 million grams, we extract 0.5 of a gram, or 2 grams. And that's all the energy that Steve refers to that needs to go into that effort. And that's what makes gold precious, right? Yeah.
I totally agree with that. That's exactly, and it's very easy to print treasuries because there isn't that energy that it takes to produce a treasury and sell it. There is some marketing or some cost of it, but it's mostly service. But again, that's the investors needs to understand that is the real value. It is the energy and all the materials, labor, and management and risk that it takes to produce. That's where the real value is. And investors are going to be re-educated to that in the future. So thank you for sharing that. And I totally agree. I look at the numbers. It's obnoxious the amount of energy that has to be consumed to produce gold. Silver, of course, with the higher grades, much less energy, right? Is much less energy to pull that silver out. But yeah, that's what makes gold so valuable. It's all about that energy. Yeah.
Yeah, and Jorge, that was certainly one of the things that stood out when we were at the Seguela mine earlier this summer. And of course, also just seeing the sheer bulk of the equipment and how much energy it takes to run that. So well said. And with that, we're going to start wrapping up here. But Steve, I wanted to thank you for joining us today and just let people know that they can find your research where not only do you dig into the energy, but also the metals and the miners at the srsroccoreport.com, which link to that is in the description field below. And it's really nice to have you dig into some of these things along with someone from the mining side. So Steve, thank you for being here today. It's great to see you as always.
Yeah,
And
and thank you for, oh, sorry, go ahead.
go ahead.
No, you just broke up, but no, I do appreciate being a part of this because I want to get more education to why it's important to own the metals and the miners. And I think, yeah, I do appreciate it. And hopefully we could do this again in the future.
Well, I will certainly look forward to that, and might add that I am a subscriber to the SRS Rocker
Yes,
Report.
you,
Appreciate
yes, you are.
videos and articles you make, and a lot of information you pack in there, and it's certainly helpful just to be going through some of these concepts time and time again and really letting it sink in. So thank you for what you do there. And Jorge of Fortuna Silver at fortunasilver.com. Thank you as always for everything you do in terms of sharing your insight and also helping us to continue to get some of these metals to the markets in times that are not always the easiest, but great to see you as always here today, Jorge, and thank you for joining us.
Great to be here, and thanks for the opportunity to share here with Steve and yourself.
Well, appreciate that, as well as everyone who is out there watching today. Thank you for joining us, and hope you enjoyed this, found it helpful. Hopefully we had a few jokes in there to make you smile as well. And that said, we're going to wrap up, but everybody, thank you and have a great afternoon.
Thank you.
And we